Cost plus pricing. In this session, we are going to explore some of the salient features of the pricing techniques based upon cost. So let's start cost plus pricing. Okay, as the cost is based upon either the full cost or variable cost. So first of all, let's have a look at some of the important characteristics of the full cost plus pricing. In the full cost plus pricing, first of all, we calculate the full cost of the product. And when we say full cost of the product, that includes the variable as well as fixed costs. So I mean to say direct materials, direct labor, variable overheads, fixed overheads are all compiled together, added together, and then we add certain profit markup. You can say fancy calling it profit margin. We add into the cost to arrive at the selling price. Now, under what circumstances it is carried out and how the companies achieve the advantages out of it, what attraction do they see in full cost plus pricing? Okay, number one, you might have noticed it's very easy to use. The method of full cost plus pricing is very easy to use. When I say very easy to use, if I take you back to the previous slide, you would be able to notice that the company or the organization has already calculated the full cost of the product already. Okay, they need to know how much a TV costs, how much a car is worth, etc., etc. So they have calculated the full cost already. All they need to do now is add the profit markups. So it is very easy to use for the accounting and finance people. Secondly, very less time consuming. When we say less time consuming, the cost has already been calculated. All we need to do is add some profit markup into this and then abracadabra, and we end up with the selling price. Okay. Thirdly, using this methodology, the business firms ensure that all their costs are covered. So the selling price aims to recover full cost of the product. So it's kind of a satisfaction for the entrepreneur or the business owner that whatever the product they are selling in the market, it is actually recovering full cost. Also, it avoids the cost of conducting the market research, because there are other techniques as we are discussing in various sessions such as target costing, etc., or market-based pricing techniques. They all are very expensive these days because the data or information doesn't come for free. So we have to conduct extensive market research, exhaustive market research in order to gather all the data and statistics and the sentiments of the market, and then we actually find out what customers are willing to pay. So if we are talking about mediocre firms, the firms which are very small or even medium-sized, they do not like to spend money on the market research, and they simply calculate the cost and add some profit elements to arrive at the selling price. Well, of course, no technique is 100% accurate, so it has its own limitations as well. So let's have a look at some of the disadvantages. Okay, so firstly, as there is no market focus from the cost plus pricing, so it avoids any external focus. So an entire focus is internal, meaning to say we look at all the paperwork like the material price quotations and invoices, or we look at the payroll sheets, or we look at all the bills coming up in form of overheads, and from the internal information we derive a selling price. There is no market consideration, so there is a huge risk that if we are going to use the cost plus pricing technique, then of course we may be ignoring the customers. We may charge a very high price, or we may charge a lower price, we don't know. Another problem in cost plus pricing is that when we actually include the overhead costs in the product, there is a huge guesswork and there are difference of opinions. A number of firms, actually majority of the business firms or the organizations, use absorption or traditional method of absorbing overheads into the products, and that absorption is hugely a guesswork. either based upon the labor hours or machine hours or any other stuff we discussed in different sessions. Last but not the least, it is full cost plus approach is inappropriate for special pricing decisions. Like in relevant costing, you study that especially for make or buy decisions or further processing decisions, or maybe you can say accept or reject decision, pricing quotations or bidding decisions, we use relevant costing, and a number of times full cost plus pricing leads to not accepting the bids or losing the customers, etc. Now we can move on to the cost plus approach to pricing towards variable cost plus. It's very similar to full cost plus, only difference is that the cost does not include the fixed overheads. We only consider the variable cost. So the benefits and disadvantages are very similar, apart from the fact that variable cost plus pricing can be used in making decisions as well. So again, it is very easy to use, appropriate for pricing, special pricing decisions as I was talking about. So in a different session, we will discuss the relevant costing or incremental costing techniques, and you will see how the variable or marginal costing is going to help us in arriving at special pricing decisions. Appropriate for limiting factor decisions. So when we will be running, or maybe you have read it already about the limiting factor scenarios, then the variable or marginal cost techniques are very helpful. Of course, some disadvantages that it ignores the fixed cost. So any selling price we charge to the customer does not include the fixed cost. So there is always a risk that whether our price is recovering actually the fixed cost or not. So the organizations have to be very, very careful when they use the variable cost plus price. Okay, right. My slides were here. Right, sorry, my apologies. Coming back to ignore the fixed cost. Secondly, again, just like the full cost plus approach to pricing, its entire focus is internal as well. It is not appropriate for long-term pricing decisions. Why? Reason being is, as the price calculated based upon variable cost plus approach to pricing is low, it is a lower price, we simply cannot use it for strategic decisions when we are going to charge a lower price forever. It's not very, very suitable or economical. Well, to some extent it may be used actually, because the things are changing in the world. A number of firms actually play with the volume. They create a huge amount of volume of products and services by reducing the cost as well. Okay, but we will discuss that separately in a different session. Thank you very much.